So do you want to know how real estate investors really get rich? Stay tuned and I'll tell you. Hey, what's up guys? My name is Graylan Stewart. I am a real estate investor. So my channel is mostly about wholesaling real estate. That's what we do all day, every day, nationwide. However, to really build wealth, I buy rental properties, single family residence, to where I can put families in there and then I charge them a rent price over and above my mortgage price if I have a mortgage. And then the in between of that price is what my profit is every month. So let's just dig into it. So like I said, we mostly do wholesaling real estate. So that's exactly how we find our deals a lot of times. I have bought from wholesalers on occasion, but being a wholesaler myself and running a wholesaling business, we get tons of deals coming through our pipeline. So what that allows me to do is cherry pick the good ones, okay? So what we can do is we can end up flipping a house. If it's a house that we think we can make a lot more money on as opposed to wholesaling it, then we can decide to do that. Sometimes we will hotel a house to where we'll actually just buy it, maybe clean it up, maybe not touch it at all, and then put it on the MLS to get a bigger fee than we would have wholesaling it. Or occasionally we will keep houses to keep for long-term wealth. So really that's the key, okay? So if you've never heard of this term, it was coined by a guy from Bigger Pockets. It's called the BRRRR method, and that's BRRRR. Yeah, 4 R's. So what that stands for is you buy, you rehab the property, you rent it out, you refinance it, and then you repeat the process. So it's really simple, and that's exactly how investors can really become wealthy quick, okay? So it doesn't take a ton of properties. Obviously, it depends on probably your market. It depends on if you buy it in cash or not. Depends on how deep you get the discount. And it depends on, if you have loans on them or not. But the whole premise of the idea of the BRRRR strategy is exactly that. So what you want to do is buy a property. Now the key is to buy the property at a huge discount. So that's where having a wholesaling business is beneficial, okay? So for example, I can buy a house that is a $100,000 house all fixed up, but maybe it needs a lot of work, okay? So maybe we buy that house for $30,000 and we might put $20,000 into it to fix it up. So now we're all in for $50,000. So we have a $100,000 house that's in perfect condition now for $50,000 because we bought it for 30 and put 20 into it. You follow me? All right. So now we're all in on this house for $50,000. We found a renter, and in my business, we typically do rent to own on most of our properties. But however, I do have a handful of just regular rentals as well. But nevertheless, whether you do rent to own or just regular traditional landlording as just a regular rental, let's use that same scenario. So I've got a $100,000 house, okay? I bought it for 30, we put 20 into it. Now it's in perfect condition and rent ready. So I'm all in for $50,000 on this property, okay? So now I have $50,000 worth of equity. So let's just say I got a loan. Let's just say I got a hard money loan for $30,000, and then maybe I got a private partner to give me $20,000 so that I don't have to put any of my own money in the deal. Or you could even say that I paid the 20 out of pocket, okay? Nevertheless, I got a hard money loan for $30,000. Of course, there's a little bit of fees involved and holding costs and that kind of thing. But let's say I bought it for 30. With my fees and holding costs, maybe I'm in for 35. Okay. Now I've put 15 more into it because I counted that 20 kind of all in on the deal. So I'm all in on the property for $50,000. Okay. I found a good renter. Obviously, you want to do your due diligence on renters, just like you do on properties when you get them under contract. So you really want to vet renters out. We always do a background check and a credit check, both. Obviously, we're not looking for perfect credit. We want to give people opportunity to be in a property and without a lot of trouble. But at the same time, we're looking for, have they had recent evictions or not, and those kind of things. And background check wise, as long as they're not a pedophile or something in that respect, or have some really serious crimes, we typically can look past minor things. But Nevertheless, you buy the house, you remodel it or rehab it, okay? So that's step 2. Then step 3 is renting it out, okay? Now, some lenders are different. Like if you're getting a loan from a bank, they will typically give you at least 70% of the property's value. But most banks these days will give you 75 to 80%, okay? Almost all of them that I've dealt with have done at least 70%. But some of the good local banks will even do 80 to 85, I've even seen. So, but let's just assume you can get 80% because that's pretty typical for most properties that I've done. They'll always give me 80%, okay? So let's say you got the $100,000 ARV, okay? That's what they appraise it for. And you might get lucky. Sometimes they appraise it higher than you expect. Sometimes it might be a hair under, but usually the local banks will work with you. You can say, well, here's my comps that show that ARV should be 100. And because I actually did this and I showed them the comps, they're like, hey, you're right. We'll go ahead and give you the $100 appraisal value so you can get $80,000, okay? So in this scenario, follow me, okay? I bought it, I rehabbed it, I got a renter in it, so now it's time to refi, okay? I'm going to refi it for 80 cents on the dollar, which is 80% of the ARV. So the ARV in this instance is $100,000. So they're going to give me $80,000. So now that's a $30,000 gap, right? So immediately $30,000 goes to pay off my hard money loan, and then that $20,000 that I borrowed from private money or my own money pays me or the private money back. And then I have that $30,000 that I get completely tax-free. The reason it's tax-free is because it's in a loan, so it's not like income that I'm getting. It's actually just tax-free money that I'm getting. So that's $30,000 I get in my bank account to do whatever I want with, completely tax-free. Also, I've got a property now that I have 20% equity still left in it. So that increases my net worth by $20,000. Also, I'm renting this property. Usually, if I'm going to put $80,000 on a loan, I'm probably going to get at least $1,200 to $1,500 a month in rent on that property. Most investors want 1%. What that means is whatever they're purchasing the property, multiply that by 1%, and that's what you should get on a monthly basis. Let me get my calculator out for this example. So $80,000 is what I'm in the property for after my refinance times 1%. So I should be able to get $800 a month like a minimum. That's your bare minimum. But on an $80,000 loan with property taxes and insurance and interest rate, I should be able to get that payment probably in the $600 range all in, somewhere thereabouts. So if I did the 1% rule to where it would be $800, that's $200 cash flow. But typically, I like to be more than 1%. That's why it's beneficial to have a wholesaling company, because I get the price deeper, So plus, I can usually rent a house and I'm all in 80 grand for the $1,200 range at least. So that would give me a bigger cash flow. But that's exactly how investors get rich quickly, because there's a lot of instances to where, I get this property for this same scenario at, all in for 50, but that doesn't mean you have to do an $80,000 loan. Maybe I just want to be paid back, the 30 for the hard money and the 20 for my private money. And I just put a loan on for 50. So then I have a net worth of $50,000 because, it's worth 100. I only loaned 50 on it. So I got all the money that I owed back, no extra money. So I have 50,000 equity in the property. And now a loan for 50 grand, is probably like $400 a month, somewhere in that ballpark. If I can rent that for $1,200, that's a huge cash flow. That's what, $700 a month, whatever that math is. If my loan is or if my payment is $400, I guess that would be $600, $700, $800 a month cash flow. So that's huge. So not only do I own the property forever, I'm completely in the property for $0. One scenario, I could grab 30 grand in my pocket, tax free. The other scenario, I can just keep it in the house and get all the money back to pay people back and keep 50 grand equity. But nevertheless, both scenarios, I get between $400 and $700 cash flow per month, every single month forever and ever. So that's always going to pay me. But the biggest benefit is the depreciation. You get to depreciate a house on your taxes. Now keep in mind, I'm not a CPA or an attorney, so consult your local CPA on this. But from my understanding, my CPA told me that I can depreciate this house for 27 and a half years. That means you get to write off, the house. I think you can't write off the land or vice versa or something. And I'm not a professional. All I do is get the properties and my accountant handles it. So all I know is we depreciate it over 27 and a half years. And the property does appreciate over time, because if you hold on to it long enough, whether we're in an up or down market, the house is going to increase over time. So keep it forever and you're going to win. For one example, this actual example, I actually did this 3 years ago on a property, my very first BRRRR property. I actually did buy it for 20 grand. I bought it for 22 grand and I was in it for like 15. So I was all in for like 45 or so. And I actually refinanced it at the time. I think they appraised it at 68,000. So I was able to pull some money out. But now that same property is worth like 110,000 because the market has blown up in the last 3 years. So I could refi it again, but I don't want to because I don't need to. But my payment on that house is like literally like $400 a month. We're getting $850, and I could definitely raise that rent, and I'm probably going to. I could probably get closer to $1,000 a month on that property now, and it's worth 110,000 or somewhere in that ballpark. So it increases my net worth even more, because I think my loan on it is in the 45 to 50 range. I don't know exactly, but that just increases my net worth. I've got cash flow forever, and I own the property, and I have $0 in the property. So anybody can do this. You don't have to be rich to do this. You could actually buy a deal. Any hard money guy will give you a loan if you get the deal low enough, okay? You don't have to be a professional real estate investor. You can literally start by buying a house at a discount, get a hard money loan on it, get a renter in there after you remodel it a little bit, borrow money, put it on a credit card, whatever you got to do. I don't care. But anybody can do it is the point. Then you can get your money back after you refinance it, pay off the hard money guy, pay off your credit cards. Now you've got a cash flowing asset that's going to just increase in value over time to where it's going to pay you forever and ever, and you're in it for $0. So what better way is there to get rich than the BRRRR strategy? In my opinion, it's great. So if you haven't heard of it before, now you have. So please like and comment. Give me a thumbs up. I'd appreciate that. And subscribe if you've stuck around this long, for sure. Anyways, thanks for watching, and I'll see you in the next video.